We have definitely seen those Asian sovereign bonds among the worst performers in terms of local currency debt. Are there any opportunities around, especially with cheaper valuations, if we see a turnaround with China?
Well, I think with the emerging markets now, value's being restored in a yield sense. So you're starting to get carry back. In fact, we're back to our long-term averages if you look at emerging markets around the world. I'd say, I pick up on your point just there before, Asia is late to this cycle. So it's more about LATAM, Eastern Europe and Africa and yields here at the moment, where they've been hiking aggressively now for probably close to 2 years. Asia's coming late to the party. We've had much lower inflation and a lot more stable, and I think that's had a lot to do with what's been going on in China. But we need to watch China right now. The second half of this year, if they're going to have any chance to hit their growth target, they're going to have to double down on fiscal and monetary policy spending here to really boost the economy. And I think that's going to have reverberations around the world, particularly for emerging markets. There should be an early sign of a pickup there. So watch China right now. I think we're back, have a mindset something like 2009, 2010, where it stepped in and potentially saved the world. So maybe this global slowdown could be prolonged, as most people are predicting sort of 2023 recession-type numbers now.
So in this case where you're seeing a little bit more upside surprises coming from China, how would you position for opportunities in the region?
Well, right now you can see that equity markets have already started to pick up on this and they're bouncing. On the bond markets, though, it's probably a lot more supply coming to the space. So we could see yields drifting a little bit higher here, but we still haven't got inflation rolling through in China right now. Producer price index has started to roll over, PPI, but when we look at the China bond market, still performing really, really well. So it's about a carry environment there at the moment. But I'd say there's some more supply coming through in the short term there if they're going to have another go at boosting the fiscal policy again.
Which of the markets around Asia do you see as the main beneficiaries if we do see that stimulus-driven recovery from China?
Yeah, well, definitely the interlinkages within the region are getting tighter and tighter. As we like to say, Asia's just getting more Asian. Intra-Asia trade is far more important than what they're doing with the rest of the world these days. So picking up on your point there, South Korea in particular, Japan, Vietnam, those type of countries that are very interlinked in that manufacturing cycle and heavy industrial, they tend to pick up straight away as soon as you see this boost. Right now, though, it seems we've still got some other issues, particularly with the trucker strike happening in South Korea. Their interlinkages with all the semiconductors and all the various parts for cars and the likes. That's creating another bottleneck for global markets. And I think also another round of inflation that's probably going to reverberate, particularly in the developed markets. The thing I think we want to focus on here is developed markets are taking on emerging market-like characteristics. You're seeing more volatility there. So we're asking ourselves, are you getting rewarded for the developed markets as much as you are in the emerging markets, where the yields are substantially higher and they've been hiking rates for close to 2 years now?
How does that place a market like Australia, which obviously with the commodities and energy exposure has been looking like it's well placed to benefit from an equities perspective and also potentially from the stability of the sovereign perspective as well? But it seems like even in this market, there's a lot of repricing as to what these expectations from the RBA will be, whether it is going to be neutral or whether neutral will actually be a lot more restrictive than what we're seeing right now.
Well, I think your answer at the end there was spot on. It's got to be a lot more restrictive at the moment. But everybody's got to back away from zero interest rates or yield curve control and move into the quantitative tightening mode. Even in Europe, we're seeing this where you thought it was unbelievable that they would start to hike rates again. They're having to play catch up now as well. I think Australia's well placed, particularly with this export cycle likely to pick up in the second half of the year and well into 23. Then I'd say the sovereign then has a lot of flexibility as they start to accumulate that trade surplus again. So that's going to give it a bit of a buffer in terms of not hiking too aggressively. But definitely inflation is here to stay right now, and that's going to change central banks' thinking. Unfortunately, they're thinking that it's a demand issue, and this time it's a supply issue, and they don't control the supply side. So it's going to be a very tricky space right now.
And the BOJ seems to be thinking very differently from other central banks around the world. We have seen, of course, these purchase operations for 10-year JGBs. We're expecting another one today. Could you see more operations in the tenors that are above 10 years, which we haven't seen in the longer part of debt before?
Well, in fact, we've been writing about and saying that we actually think they need to disband this yield curve control, particularly as the yen starts to move higher and higher. We've already heard the BOJ starting to talk about the currency, and it's going to have volatility impact on the local economic backdrop. We think that as you get closer and closer to 140 and maybe even 150, we've been in this sort of environment with QE for over 20 years now. Inflation's coming to Japan. They're going to have to think about disbanding this yield curve control, just as Australia quickly turned and disband yield curve control. I think we should think about BOJ heading in that direction as well. And then that's probably the only thing that's going to keep the yen from continuing to sell off.